Hello, this is Chuck Carnevale, and with this video, I'm going to do a fast graphs fundamental analysis of United Parcel Services, UPS. UPS went public in November of 1999, and since that time, they've produced a reasonably solid record of operating earnings growth. However, I would like to point out that the company does have some recession sensitivity, as you can see by the 11% drop in earnings in 2001 and two consecutive earnings drops during the Great Recession in 08 and 09 of 16% and 34% respectively. However, they followed that recessionary stress with some very strong recovery coming out of the recession through 2011. Although I consider this record of earnings growth decent, this is not really what attracted me to this company. My primary objective for considering United Parcel Service was their dividend. And here we're going to plot the dividends per share since they went public, and you can see they've been very consistent. They did pay 5 dividends in 2008 because they changed the dates where they paid the dividends, which was essentially a freeze-in dividend. And they also froze their dividend in 2001 and 2002, but in neither case did they cut their dividend. This green shaded area represents all of the company's cumulative earnings over this time frame, and this area below this white line represents the portion of dividends that the company pays out. As you can see, they pay out under normal circumstances approximately half their earnings in dividends. Of course, their payout ratio got high during the Great Recession. The bottom line, since I'm looking for consistent dividend growth, United Parcel Services fits that bill. It currently offers a 3.1% dividend yield, has an A+ credit rating, but as I'll discuss later, it does have a rather large level of debt due to recent acquisitions that the company has made, as well as some investments in expanding their business model. Now, when I put monthly closing stock prices on this graph, it becomes readily apparent that this company has consistently traded at a reasonably high valuation. I'm now going to add a second valuation reference line, the normal PE ratio calculation, and since it went public in 1999, its normal PE has been approximately 22.5. I always look at these valuation references as ranges. As I shorten the time frame, and I'm going to drop it down to 15 years here, you'll see that normal valuation since 2005 has been approximately 20. And although this does not meet my normal focus on sound valuation relative to the company's historical valuation, the company is moderately undervalued with a blended PE ratio of 18.4. But as previously stated, my primary objective here is for the dividend. So if I shorten the time frame a little more here, you'll see that this valuation reference stays around 20. But then when you consider the amount of dividends the company has paid out, the capital appreciation component here has been reasonably decent over this time frame, plus dividend yield, giving an average rate of return of about 11.3%. So that's very attractive, and that's coming from a time when it was trading at a PE ratio of 24. So there is capital appreciation potential here, but my primary focus on looking at this company is for the dividend income. So with that said, the next thing I'd like to look at here is the company's dividend record, and I'm going to use the period 2007 to current time, or 1 year prior to the Great Recession. As you can see, they did freeze their dividend in 2007 versus for 2008 and 2009, but as I pointed out, they did pay 5 dividends in 2008. However, when you add up the growth rate, it's averaged about 7.5% over this time frame, and that's consistent with how much their dividend has increased even in the last 3 or 4 years. Consequently, I'm very comfortable that this has the opportunity to give me an above average current yield of approximately 3.1%, with the opportunity for that dividend yield to grow rather nicely over time, as you can see by the yield on cost column here. A 3% yield in 2012 turned into a 4.2% yield by the end of fiscal 2016. Now I'm going to turn to fund graphs, or the financial underlying numbers, and examine the debt record a little bit. The dark blue shaded area here, bars are long-term debt, and the mustard green color is total debt. And as you can see, the majority of their debt is long-term debt, and part of the reason they've taken on this extra debt is to make a big acquisition they made last year, as well as expand their business internationally. One thing that really attracted me to this business was the predictability and consistency of their revenue stream. I've added gross revenues here to the graph. As you can see, their revenues have increased from $20 billion in 1997 to approximately $69 billion in 2016. So the company generates plenty of revenues to cover and handle their debt and other obligations that the company. Now I'm turning to the cash flow statement and looking at dividends paid versus free cash flow. As you can see, free cash flow adequately covers the company's dividend without any problem. And this is one of the most attractive things I find with this company currently, is that I do believe that their dividend is secure and safe, and as I previously mentioned, likely to grow into the future. Additionally, UPS has a strong history of generating high returns on capital, approaching the 20% range for the last fiscal year, and this gives them the flexibility to reinvest in their business. The company has declared that dividends are a priority. They can also utilize these high returns on invested capital to maintain a strong balance sheet and also have money left over for share repurchases. Since 2007, the company's reduced their share count from just over 1 billion shares to 883 million shares at the end of last fiscal year. So in conclusion, I think United Parcel Services represents a decent dividend income opportunity with a current yield of 3.1%, especially when it's so hard to find decent dividend growth stocks in today's rather overheated market. So I'm going to take a look at the forecasting calculator and run some calculations. One of the things that I always do before I make any investment is I actually try to run a calculation of what my reasonable expectations would be. So I'm using the normal PE multiple calculator here, and I've chosen the 20 PE ratio and historical normal PE ratio that I talked about earlier. And as you can see, the company's trading at a blended PE of 18.4 right now. So by year end this year, if the company would move back to a normal 20 PE, the rate of return, total annualized rate of return, could be 18.8%. And of course, dividend growth associated. As I go further out, that yield would still be double digit at 14.3%. The company has widely followed. There are 27 analysts giving a forecast for 2017 and 25 analysts giving a forecast for 2018. That's usually about as far out as I like to go with my personal forecast, because as you notice, the number of analysts giving a forecast for 2019 drops down to 6. So my target rate of return would be double-digit rate of return over the next couple of years buying the stock with a good 3.1% dividend yield. I think it's very important to have some reasonable expectation of what rate of return an investment might give you. I like to call it investing with my eyes wide open. I think this is a decent investment at these rates from a high-quality company with a good dividend yield. As always, do your own research and due diligence.